Thank you, and good morning to everybody. Let's get started. So thank you very much to each one of you to agree to come on the panel this morning. I have a very interesting mix of panelists, and starting from the end, we have Sid Talwar from Lightbox VC, early stage investors, some great investments like Melora, Flinto, Ferlenco, Fasos. We have then Sandeep Reddy, who's the co-founder of People Capital, fund with some fantastic consumer investments over the last decade or so: Unibic, 24 Mantra, Banjaras, Maya's Foods, IFM, Voila. We have Sahil, which is a mature buyout fund from Advent. Advent International recently picked up a controlled stake in Dixie Underwear, and Crumpton Greaves. They bought out the Crumpton Greaves consumer goods business. So I think it's very interesting that the three of them actually pretty much span the entire investment life cycle for a brand. And then we have Ritesh Chandra from Avendus. Avendus is one of the most successful investment banks, having done a large number of consumer and internet transactions. So we have the benefit of Ritesh's couple of decades of experience. So our subject today is valuations, always a fascinating subject for everyone within the investing universe. So let me start with a general question to all of you. I'd like you to field it. I think valuation expectations in consumer deals continue to remain somewhat high, and I know it's a mixed bag of feelings here in terms of what is high, is it relative, and I'd like to get a perspective from each of you whether you believe consumer deal valuations are in general, consumer deals are in general perceived to be expensive than others. If yes, why? If not, why not? So Sid, can I start with you?
Okay. So I'm a VC, but I'm a very conservative VC. So
there you go.
You know, I think one of the things that we see is that valuations at our end of the spectrum are very theoretical numbers. And I think it's a very general statement to make that valuations are high at our end of the spectrum, only because you see the newspapers and you kind of determine that what they're saying for a few companies is what the larger sector is all about. And I don't think to a large extent, especially with consumer deals, and especially when you break that down into companies that are selling a product rather than a marketplace in general, that valuations tend to be very, very high. But it's so theoretical, and as you go to span this, it becomes less and less theoretical in nature. But let me tell you how we look at it. I think we look at it, and unfortunately many people look at it as mainly top-line growth and a multiple of that. And I think one of the things that we try to do is bring in, even at a very early stage, and I'm not an angel investor or a seed investor, we're Series A and B, so we're not that early, but we try to bring in all the other economics of a business. And for us, especially more than value, it's about how much money it'll take to create that value. And so burn rates become very expensive, very important. We're very aware of the valuation trap, which is the higher your value, the more difficult it's going to be for you to raise money or create liquidity. And the key there is to make sure that when people are knocking on your door and times are good, you shouldn't get carried away because someone has to come down the road and still value you. And so one of the big parts of how we look at this is saying, I will give you X amount of money. You have to create 5X the value over that period of time. And if you can or cannot, then why can't you? It's a manipulation of a SaaS rule of thumb called Rule of 40, which is an explicit relationship between your revenue growth rates and your burn rates. So that's how we look. That's how we look at our consumer businesses. It's a little bit more than just saying, I will give you an X 6 times multiple on revenue and now go forward.
And do you believe young entrepreneurs understand that when they go in, or do they come with these perceptions which you have to course correct?
I think unfortunately we have created an environment where entrepreneurs can use valuation as a scorecard for how they're doing. And it's so unfortunate. It's so dangerous because of the theoretical nature of the number. It's not based on how well or poorly you're doing. It's based on a market and how the market is moving. And the market is constantly moving. And so if your value is going from 100 million to 500 million, it doesn't mean you're doing that much greater. Or from 500 million to 200 million, you're doing that much worse. It's just the market moved on you. And so if I was an entrepreneur, unfortunately, you have to explain this. And we take a lot of time. We take months and months and months to make a decision. And it's part of that process that we kind of speak to entrepreneurs about this. But I think the ones that realize that the health of your business and your ability to be able to create self-sustainability is far more important than the value that someone's pegging. Those are the guys that we look after and they look out for anyway. And so our entrepreneurs understand that.
All right, I think that's interesting. Sandeep, what's been your experience on both? As you're a classic mid-stage investor, pick up assets from early stage funds, nurture and grow, and then pass it on to a strategic or a larger fund. So how do you see valuations in that context in terms of both entering and exit and the journey in between?
Right. Nandini, not too dissimilar to what Sid was saying. We tend to be probably a little early on. I mean, the instances where we are buying assets from other players are low. Many a time we're either creating these platforms ourselves, or these are fairly early businesses that we get involved with. So valuation is something that is more a factor of the discounting that we do relative to the value that we think this thing can create over a period of years that we would stay invested in. So it's more a model that we come out with, and it's a number that is more a discounted cash flow or something to that effect. I guess a lot of our thoughts would be very similar to the way Sid and Lightbox think about it.
All right, thanks, Sandeep. Sahil, I think you're at that classic stage, which is probably end stage of just pre-IPO, and you're a large investor looking at control transactions, and clearly what people like Sid and Sandeep invest in really becomes your source of transactions, other than, of course, corporates, etc., who are trying to divest. So, again, how do you? I don't wish to anchor this in just valuations, but what are the matrices that you seek out when things start to come on your radar, where you still believe there is value left to be created from the price that you buy it at to the price you think or the value that you can create at exit?
So, to start the answer on valuation, valuation has always been expensive in consumer. I think even 10 years back, FMCG as a category would always trade at 30 plus times forward earnings. What's happened over the last half a decade has been that valuation of other subsectors in consumer have started catching up with FMCG valuation. And so valuations across the board have gone up. So having said that, I think our job as investors and as late-stage investors is to get through the clutter of valuation and see where fundamentally valuation is given to us. I don't think plus minus given we compete against public markets. So if we do not pay valuations that an investor, a seller would want, a public market option is quite an attractive option where we stand today. So how we think about things today is, if the valuation is going to be high, for what type of businesses are we fundamentally comfortable paying for paying those valuations? And so when we start thinking about matrices that you're talking about, I think the first thing that's extremely important to us is that the business has to be a strong business. And for consumers, the strength of the business is fundamentally defined by the strength of the brand and strength of distribution. So as we do our work, we will look at matrices such as top-of-mind recall, spontaneous recall, and aided total awareness. We'll also look at how strong the distribution network is. What is the strength, how deep does the distribution go? What is the longevity of the distributors? What is the typical churn? Because those are the two fundamental pillars that can then drive to disproportionate growth over our investment horizon if we had to pay a rich valuation. Unlike some other investors who may start earlier, we typically like businesses that have good return on capital profile and good cash generation. So those matrices start becoming important to us. As a result, typically we will not invest in businesses which are negative from a cash flow basis. We like businesses that throw off operating cash flow and can fundamentally fund the capex through internal accruals, especially if we are paying punchy multiples, which the environment is in today. And the last thing that we look for in matrices and businesses is where can we create value? Our approach to investing has typically, as a late-stage investor, is not just backing an entrepreneur and letting him drive the business. We look at a lot of control deals, but we also are looking at minority investments. But the fundamental overarching thesis is where can we come in, get our hands dirty, and then change the direction of the business from a step change, so make good to great. And that is really where we focus a lot of our time on, driving value creation in businesses. And with that value creation, if you can take a differential view on growth, vis-a-vis what others may look at, then you have the ability of paying differentially for a business as well.
Thanks, Al. I think that there was some really insightful stuff here. Ritesh, I think you've had, like I said, more than a couple of decades of experience in doing transactions in the consumer as well as the internet space, and they sort of merge very nicely. What in your view has been and what in your experience has been this entire journey, especially around as you do sale and buy transactions on valuations?
Yeah, so as some of the other panelists have also mentioned, I think valuations in consumers have always been rich. If you look at the last 3-4 years or 5 years of valuations, especially in the FMCG space, they've been pretty much stable at about 30-35 times EBITDA. What's interesting is that we are now seeing other categories emerge which are attracting fairly rich valuations. I have two fundamental hypotheses on why this is happening. One, there is a tremendous scarcity value for good quality consumer assets in India, scaled up consumer assets. There are literally very few assets in the country who've scaled up beyond a threshold and have the ability and have demonstrated track record. So investors are willing to pay a premium for those kind of assets. The other larger question is that, what is the opportunity that people are playing in? I think the market itself is expanding very dramatically. Historically, people were used to saying, the market is growing at 5, 10%, 15%. At least in the last couple of years, the opportunity set has become very, very large in itself. And that's because the opportunity set has become larger, assets in that space have started commanding higher valuations. There are fundamental shifts that are happening in the market, and the earlier panel alluded, Rakesh mentioned a couple of issues. We are seeing a significant shift across the board, across categories, from unbranded to branded. That shift is so tectonic that you are seeing markets, just being disrupted completely. Whether it's in the footwear category, with the apparel category, the food category. If you look at your kitchens today, vis-a-vis you looked at your kitchens 10 years ago, there was nothing in the kitchen which was branded 10 years ago. Today, there's hardly anything which is not branded in your kitchens, right? That's creating opportunity. Plus, the internet is playing a great source for access. And that's driving the markets to a larger, market sizing to be much, much more larger where it is. So I think we are in for a period of time where valuations will continue to be fairly healthy across the segments.
Thanks, Ritesh. I think you've opened up a bunch of things that I'd like to focus on in the next half an hour or so. But earlier, the three of you talked about, if you see the segue again, you talked about cash burn. And on the other end of the spectrum is somebody like an Advent, which talks about positive cash flows. And that's a huge journey for any brand as it builds out. So again, back to Sid, how do you sort of coach your entrepreneurs and help them understand and measure value of sweat versus the cash that you're putting into the company? And typically in your stage of the business, you are burning. And how do you help that company get to a profitable business and eventually very steady state cash flows as you as it sort of has to magnify 3x, 3 times over?
I'll let you know in about 3 to 5 years. No, I'm saying. When we start evaluating businesses, we have very little to go by, and so you have, especially when you're trying to evaluate the value of a business at our stage, you can go by comps. But as Sahil and Ritesh were saying, if I take comps in Indian consumer, they're way out of whack. And so to bring that back is very difficult. And so you start evaluating, and for us, fortunately or unfortunately, we use our imagination probably more than Sahil uses his imagination in these things. And so, but when you have to use your imagination, then you look at a product and you have to imagine that hundreds of millions of people will be using my product or this product. And if you're going to use your imagination so vividly, then you have to go back and say, is this a good product? Is the product of any value to me personally or to our team? And then you start saying, well, what's the roadmap of this product? And you start saying, well, how much money will someone pay for this? And so what's our ARPU going to be? And if that's your top line, how much of that top line should be able to come to your bottom line? And then you start saying, well, how will the market value that cash flow today? And then realize that the market could change on a dime tomorrow, and so you start discounting that. And if you start this thought process, and by the way, this is why we don't make an investment in 10 days. This takes some time to do. This idea that, in venture you can go and get a term sheet in one meeting is, well, it skipped our generation, I think, of investors. But if you start doing that, then at an early enough stage in your conversation with a potential investment, then the entrepreneur starts thinking like that too. And we see that over and over and over again. And we start thinking about how best to build a business that's thinking about this, not thinking about how I'm going to grow purely on revenue, because the only other way anyone else knows to value your business is as a revenue multiple. And that's how we kind of move down there. And the math 99% of the time does not work. Yeah. And we are risk takers, but we're not stupid. No, that's not true. Some of us are. I'm not stupid. No, that's not true. But it doesn't work. The math doesn't work. And you can't do anything about that. But that doesn't mean that people won't try. So I guess it's a very long-winded way of saying we start talking about this early enough and then weed out people that don't want to listen to what we're saying before we start deciding whether we're going to make an investment or not.
Right, because I think a lot of entrepreneurs would come to folk like you thinking, here's money bags, and therefore I can burn money because I need to grow. As you said, there's a revenue chase that a lot of people end up, and that's a trap. Because we tend to see many fewer companies which eventually become successful, which focus on cash and conserving that cash and getting to a positive cash flow. And I'm sure you guys play a very significant role in trying to get your portfolio companies into that frame of mind and that journey. Sandeep, what has been your experience in again, acquiring or investing in companies which are probably still negative cash, and how do you see them getting to the other side of the hump, so to speak?
It's a journey. Two things, I guess, that I'd like to touch upon. One is we map that journey over a few years, break it down by where those drivers are going to come from in terms of EBITDA growth and so on and so forth. Tie incentives to that, not just in the company, but also in our own team. I think part of the challenge is getting that discipline into firms like ours, right? Where our teams understand that this money is not just an ongoing thing, and really getting that orientation to profitability. So I think it's both of those. One is having the roadmap, driving that orientation, and it starts at home, in our own home base, and then getting it down into our companies. That's really been the way
but
we've
often,
approached
don't you see that playing out as a conflict with the promoter? On the one hand, there's pressure to grow top line and break a glass ceiling if you must, and then on the other hand, you also have to have your eye on profitability, which oftentimes comes with some element of control and conservatism and hold back. So how do you help your companies balance that out?
So 2 points. One is, in our case, we don't have too many of these promoter type situations. We have managements, right? And management also applies within our own teams. And I guess, the short answer to that is, no one said it's easy. That's why we pay them the big bucks, right? I mean, and typically we paint a picture for our management to have a fairly decent price, in some instances going into 3-digit crores. And I guess that's why they get paid to achieve that. If everyone could do it, then I guess, we'd be in a different place.
Right. So Sahil, back to cash. Just, I think you started this little topic. When in, again, a life cycle of assets as you see on your radar, and you said the cash metrics is extremely important for you. Would you completely discount a company that's sort of had a trailblazing journey into creating a whole opportunity and market and created its own niche, so to speak, and has great revenue numbers, but would you completely discount that, or?
So I would say our general preference is to buy into businesses that have profitability. Having said that, on a very case-specific basis, we will evaluate transactions where they currently may not be making any profit, but the line of sight into getting into profitability is extremely strong. That could mean that, for example, marketing has been overinvested in A&P, but for strategic reasons of building footprint, building presence, building reach, but which can then be scaled back down to industry averages if it was overinvested historically. So if there's a clear line to getting to profitability, but if the same answer was that I'm just going to scale down marketing and I have no line of sight on getting to that profitability level, then it becomes a lot harder. For consumer businesses, typically the big driver of profitability to a large extent is building out the A&P spend. Because that's what drives adoption of the product, that's what helps drive distributors to own the product, helps drive awareness, etc. And it's finding that balance. And as long as we feel that over our investment horizon, if not in year 1 or year 2, but clearly in year 3 and year 4, that's profitability can change and the cash burn becomes clearly 0 to positive and driving to good ROCE profiles, then that's something we'd consider. But Nandini, to be honest, that's more of an exception, not for the type of businesses we look at, and not the norm. And that's why, as an organization, at least to date, we've stayed away from the entire e-commerce wave, because although this very consumer-linked, it's fundamentally businesses that have not throwing off any true cash flow to date.
If I may add, obviously, Advent comes at it a different perspective. But we've tended to have found a lot of value in hairy situations. The right kind of hair, obviously, but stressed businesses.
Right kind of hair?
Well, in the sense of the right kind of challenges. But we found a lot of value in distress, where we've been able to go and turn things around or fix a few things and so on and so forth. And in fact, going forward, I think we would increasingly play even more into that.
Right. And I think I will come to the whole topic of, deal sourcing in a bit. because it all comes down to, so distress is a great. Back to, I think, Ritesh, and I'll close that out on revenue versus profitability. And I think Vendis has had you've seen transactions across internet, which are primarily revenue driven and some pretty crazy stuff. And then you've also seen fairly profitable businesses change hands. What, in your view, is this entire, how do you balance that dichotomy, and how do you become a banker for a different cause every time?
Yeah. So I think first and foremost, in any business, cash is king. Let's not forget the golden rule. There is now, at what journey, what is the company in that the cash comes through is something that you've got to take a call on every independent business separately. We've seen a host of businesses throughout their life cycle. We've seen fairly mature businesses which are operationally cash positive, but on a net basis are still cash negative because everybody's investing for growth. See, a distinction has to be made on what is the nature of the cash generation. If the cash generation is not there largely because the cash is being reinvested for growth, I think it's a great sign, because to my mind, the promoter is betting on the opportunity to become much larger. He's betting on a much stronger play on what's happening. And we've seen that for mature businesses as well. It's not that early stage internet businesses have this issue. For even mature businesses, the growth rates are in some industries are as high as 60-70%. Now in those situations, working capital requirements are there for cash. And businesses are cash negative at that point in time. The other issues, what Sahil pointed out, was advertising. People, especially in the early stages when you are investing to grow your brand, it's extreme, and your distribution for that matter, you have to invest in the ecosystem. You cannot just be focused on getting the cash out. So literally it's horses for courses, right? So you can't make a distinction saying that, listen, X company is not making cash, so we won't work with it. We've got to take every case on an individual basis. Yes, where I do have a challenge is where people say, listen, I'm going to burn 50 crores in advertising. Maybe my revenue goes up, scales up 10x, and hopefully I should be profitable. That's it. You're walking on thin ice on that one.
Absolutely. So I think, thanks, Ritesh. Going to the entire, I think every investor has its own DNA when you invest. Because fundamentally and intuitively you believe you can create value. And valuation is not just a number. It's really about being able to create value. And I think I heard from you, Sid, that you guys, your first test is really to look at, is this a product that I like to use? Do you think that's perhaps in some way a trap that all of us fall in because we are in the current strata of society? We can't seem to relate to products that we wouldn't use. We would love to see an epigamia. We'd love to see a karma, because they sort of appeal to us as individuals in our demographic. And therefore, if you see a whole lot of investments today are more playing to very premium kind of products. Is that a peril that we as investors seem to sort of fall in? Or are you able to look at a telescope and say, hey, this is a product that is going to be used by the larger demographic of India, which is really what consumer is all about. It's that entire demographic opportunity.
Wow, I'm so the wrong person to ask that question to. I think, I'll tell you why I'm the wrong person to answer that question, but I actually believe that the biggest mistake that a lot of people are making in consumer startups is try to address the country. That's not my responsibility. I'm not trying to address the entire country. I'm trying to find a product market fit with a specific part of the country. And if I take what, I don't know, you choose a consulting firm, but let's say BCG called from aspirers on. So people that earn 6 lakhs a year up in India. And forget that. Let's just say people that earn $20,000 and above in India. $25,000 above. So these are affluent people. Today, they account for, let's say, about 5 to 7% of the population. But their consumption is almost like 20, 25 maybe even more. In 2025, that number grows to, let's say, 12% of the population, but the consumption is almost 40% of the population. Now, we expect that consumption to be about, let's say, $1.6 trillion odd, which is the consumption of all of Germany, almost, and more than France today. And so I don't need to go down and cover all of India. I am the consumer. It's interesting, we're all men, which is I don't know why there are no women on these panels. And this is the biggest myth. I mean, and answering the question, Nandini, you should be answering this question. And the problem isn't whether it is, I'm gonna make a big deal about this, but the problem isn't how much, where my product's gonna sell. I know the majority of my product is gonna sell to people that are earning a lot in our country. I know that we have, in the next 10 years, we'll have over 120 cities with a population of over 1 million people each. So I know that distribution is going to be tough. And so using technology for distribution will be one way, but not the only way. But I also know that in my room, I don't need people at different levels of society. I need different kinds of people. I need men, I need women. I need older people, I need younger people. I want that mix. I don't necessarily need someone earning 5,000 rupees a month and someone earning 5 lakhs of rupees a month, or someone earning 1 lakh of rupees a month, all in the same room. Because my product isn't going out there. You're right. But I feel like there's enough consumption for me. Because I have LPs somewhere else. I'm not telling them I'm going to solve all of India's problems. I'm not going to solve all of India's problems. I'm going to make the right decisions for what I understand, and they're going to make money 100 years from now, but they have to pay me fees now. I'm just kidding. But I think that's an important distinction to make, because you're right. I might not know everything, but I do know what I'm going after.
I'm just trying to get the investors' DNA, and as we work with a very large subset of or set of investors, I think each of you are personalities and how you create value and where do you, and the market is huge. The market is deep, the market is wide, the market at the top is very profitable because you think there's a capacity to pay. The market at the bottom is sure large and it plays to, let's say, a Maya's or a Crompton or a Dixie. And there's value to be created and picked up everywhere. But what I'm trying to say is, is there a certain philosophy where you believe this is unique to me and therefore I can create value? So when I look at people, I look at it as control transactions, and I think you believe that control is the DNA where you believe that you can drive the future of the business and you're in control, as opposed to dealing with founders and emotions and a whole bunch of fuzzy stuff that you're not. Is that something that's unique to value creation for you?
Well, it makes it a little easier because
you're very unique. I think one of the fewer funds that go into control at a much younger stage of life, and I'm sure it's more difficult to find transactions.
Well, I think that bias just comes from the way we evolved. We didn't start off being fund investors. We were entrepreneurs deploying our own capital, and the story kind of evolved from there. So I think that entrepreneurial DNA, which historically perhaps people relied on a founder bringing, we believe we bring to the table ourselves. I guess that's perhaps the slight distinction. But just given the culture within our environment, we think that having that ability to control our destiny in an environment where you need to be at it. I mean, we really buy execution risk. And there's limited room for error, and when there are errors, you need to be able to recover quickly and go forward back to conserving cash and a lot of these things. So being able to bring the right human capital to bear, being able to make changes, being nimble and flexible, I think that becomes very important, and in that sense, this control orientation helps. It's not that it's the be-all and end-all, but clearly it's an important ingredient for us. And if you look at a lot of our consumer companies, there's been fairly consistent upgradation of talent. And especially when you're able to grow a company. Let's take a company that you've been involved in, an organic food business of ours. In the last 6 years, that business has grown about 15 times. So the skill sets that we've had in finance or distribution or whatever needs to be constantly upgraded to reflect where we're punching.
Yeah, but again, you have because it's control, and you said you probably have more management-led companies or management-run companies. Do you believe we have that set of or pool of talent which can necessarily drive value creation as opposed to just great management folk? And what has been your experience on talent in terms of value creation?
Mixed, if I were being honest.
Do they have the balls? You'll have to say, do they have the balls? I'm sorry for using that term.
I won't get into that here, no, I think part of the mandate that I hold is being able to transition very successful managers into becoming successful entrepreneurs. And I guess when I started doing this, let's say 10 or 15 years ago, I just thought that would be a little more straightforward and easier. And it's not been so. But when we do get it right, it does seem pretty easy.
You've had some great successes as well, I'm sure.
Yeah.
So moving quicker, I realize time's sort of running out. I think valuation as a subject is really, all of you are really about creating returns for your investors, right? And as it moves from the early stage to mid to growth and exit, we're seeing increasingly a lot of companies fail at auction process, and maybe I take it to Ritesh, and sort of find a route to IPOs. Why do we feel, and very successful exits after several failed attempts, I don't wish to take names, but I'm sure we're all aware, failed attempts at the right price discovery. Is the IPO market a little less unforgiving, and is the deal market or an auction process more unforgiving in terms of diligence expectations? Why do we find so much more exits via IPOs today?
So there are two issues largely that I'd like to take care of. Are public markets more forgiving? Potentially, yes. The reality of the situation is there are two different sets of investors who are sitting in there. Public market investors have the benefit of liquidity. Immediately, they have, unlike private investors, if things are not going well, they have the ability to get out immediately, which private investors don't. So the risk appetite consequently and the risk threshold consequently is a bit lower. The second element that you've got to take into account, and by and large, public markets have been frothy over the last 6 to 9 months or 12 months. And there is a great temptation to go down the public market route across all promoters. Good companies, bad companies, etc. The question that we really need to ask ourselves is that, is it right by, again, and this is a larger debate that we need to have, is a public offering for the company the right solution? It may be the best solution for the promoter. Is it the best solution for the company? And what we are seeing, unfortunately, in this country, and I think it's a function of how the public markets are, that companies are going public way, way too soon. Largely because they've faced some pushback, either because they face some pushback in the private markets, or just because the temptation of valuations is so attractive that they're just listing when, honestly, in my opinion, they should be 2 years, 3 years out away from listing. And until and unless public markets learn to distinguish that, listen, this company is not ripe for an IPO. I mean, India is potentially the easiest country across Asia to do an IPO. Try doing something similar in China. Ain't going to happen. That is the fundamental challenge we've got to address, and that's something that we need to think about.
Ted, what do you think is driving this early, pressure to do an IPO other than value? Therefore, it goes back to folk like you, probably. Is it that rush to create valuations and therefore returns that you would put an otherwise not so ready company. It comes with a whole bunch of responsibilities for the founder. And interestingly, it's not an exit for the founder. It's just an exit for, probably a partial exit for the investor. It's not even a full exit for the investor. So while we do that, with that race to discover price and a better price, hopefully, is that necessarily an exit and a return event for you? I don't know, anybody, maybe you can take it, Sahil.
So for businesses that we invest in, or IPO, at the scale that we invest in, IPO does make a lot of sense for many of our companies. But at least from a buyer perspective, some of the issues Ritesh spoke about, we see on the opposite side. Because many of the companies we want to invest in or we would like to invest in come to us for a private process and then after a point of time feel that it's not right and they'd rather go public. And more often than not, the reason is fundamentally greed and valuation, right? And at least the view we take, or if the unsolicited advice we tend to give, is valuations are very cyclical. Markets tend to be very frothy at times and then swing to the other extreme. And sometimes those cycles can be long, where it can be stuck in a tough market for a lot longer than one would expect. And if you look at some of the cyclical businesses in India, we have seen that take place, or even in secular businesses in other parts of the world. So sometimes, at least what we counsel founders is, IPO is not an exit. IPO is just a liquidity event where you end up having a liquid instrument. But then you're locked in for 3 years. Then you could end up in a down cycle in the public markets, and as opposed to getting an exit, you end up just having a liquid stock where then you have mark-to-market pressures of quarterly earnings, investor calls, and a lot more responsibility and obligations than one would have in a private situation. And to Ritesh's point, many companies in India tend to go public a lot sooner than they should be going. So, from a late-stage investor perspective, once a company reaches a certain scale, and now, at least if you're to ask us, a company with close to 1,000 crores of revenue, 100 crores of EBITDA, it starts getting to the scale where you should think about taking it public. Things that are much smaller than that, at times valuations can be quite attractive, but over a long period of time, it's more of a detriment to the business because it creates more of a distraction and takes away from the core focus of fundamentally creating value in the company and driving not just the top line and the bottom line.
I think that's very interesting. You talk about scale, and I think that you're absolutely right. The companies have to achieve the right kind of scale before it can approach something as mature as a public market. What, in your view, is consolidation amongst portfolio companies or intra-fund portfolio companies something that you consciously look at, where you naturally see synergies? Again, maybe Sandeep, you may have examples, or Sid, you may have examples of companies in your portfolio which you think naturally fit together. There's a bias to do probably similar themed investments, and therefore eventually do you think there are portfolios that could be bolted in together to achieve that scale and time to market? That's one. Second, if you were to do that, how do you deal with multiple founders and managements?
So I don't think that I think there's enough of a market to be able to achieve scale over time. And I agree with Ritesh 100%. I think, in fact, I would say the opposite way. He's the banker saying it in this direction. I would say that, you get bankers in a room and they want you to go public. It's like going to a barber and saying, do I need a haircut or not? And they're saying, oh yeah, go public. And you have to tell the entrepreneur, no, are you crazy? And I think there's so much pressure. And I think to be able, we had InfoEdge go public. And we had a lot of learning from that. And we have a company that's going public right now, in this process of going public right now in the Australian Stock Exchange. And you see the kind of diligence that's expected. And then you see the the quarterly earnings that need, and we're like, quarterly? Because it takes away then the risk that you're taking to build a business and any pivot that you might have. And we're not getting liquidity because we're stuck. We're handcuffed to the business for a while. And so, but if you take that out, you don't need consolidation to grow. you need to necessarily, and so we do not. We do not look at trying to bring companies together in order to create value faster. Because it doesn't prove anything from our point of view. We want to prove that this business and this product will grow. There's a market for it. There are plenty of mousetraps in India. There's no problem with mousetraps in India. The problem is actually, even for us, it's execution risk. So our problem is very similar to Sandeep. He solves it by going in himself.
But do you think capital is patient here? I see a lack of patient capital, and because the founder thinks he's on a treadmill to create value, and therefore he wants to sort of fast forward some events to get there really quick. Where's the peril coming from? Is it the pressure from the investors to realize that exit? What is that? So again, is consolidation a fast track route, or is it a efficient route?
I think in fact I would say flip. I think capital has to be more patient in our country than almost any other country in the world.
Has been or has to be?
Has to be. If you're not, and we show a chart, and probably be better on the other side of the table to explain this, but we show a chart of Airtel's stock price versus just the growth in mobile, and from the time they went public onwards. And we show it as an example of early stage and timing in early stage. When you get in and when you get out. And anyone who got out at the, in the early to mid 2000s kind of lost out after Reliance came in, and that stock grew 25 times in like 4 or 5 years or something. And so we use that, come back to us and say, it's going to happen. It's about to happen. Now it's going to happen. Now it's going to happen. And it's all about knowing that it is going to happen. All the things are moving in the right direction, but we have to wait. Now we have, and I'm not sure if everyone has it, but we have a limit on our fund. We have to be able to invest, watch, and create liquidity all within a 10 to 12 year span. And so we have to be careful on fund structure as well. And we have to think through that. And so we do need to think about our own liquidity, and that comes at a disadvantage to the entrepreneur who's not thinking about it from that time frame necessarily. But we have to be aware of that. But beyond that, I think the only thing we've got is time. We have to have that time, and we can't rush it. We will be the biggest losers.
Right. Sandeep, on consolidation, before I throw the question open to the House.
No, I mean, absolutely. Wherever we can try and drive synergies, we should be, and we're trying to get better and better at that. And especially given now we see clusters of assets as they've come together, not by design but by evolution. So we're definitely on that. And one of the things that we're trying to do, in fact, just a conversation yesterday, is can we cross-pollinate? So where you have some businesses that are farther along the evolution curve compared to a younger business but similar industry, broad industry. Can we take people out of the more mature business, which has resilience, and pollinate into the younger business? So trying to do more and more of those. I think the other part of your question as to the challenges with founders and so on, I think is less so with us, at least in a large number of our companies, because we tend to be in a position where we can try and enable a lot of that ourselves. But yeah, I think, and part of it is our own team getting more adept and sophisticated at that.
So thank you very much. We have about 10 more minutes to go. I'd like to throw this open to the House, and please feel free. You have some really big valuation gurus out here who've done transactions, bought and sold businesses. So any concerns, questions, please. It seems like no one's concerned about valuations after all. We're just making a big deal of nothing. So, okay, I'll take it back since we have 10 minutes. You mentioned distress also, I think. Is that an opportunity? Maybe, Ritesh, why don't you tell us? Are you starting to see increasing deal flow in consumer in distress? I don't see it that much, my view, but we're seeing some interesting ones still coming around, maybe a Videocon, and again, looking at the press, maybe a Ruchi with some nice brands. Do you really think, of course, valuations will be very interesting here and therefore value creation, but do we have the gumption to actually participate and acquire these assets? Do you think the private equity community has that? And B, whether they have the ability and skill sets to actually turn this around and realize value, given that a lot of them are really greatly leveraged?
So I think first and foremost, the number of assets, distressed assets, at least in the consumer space, are far and few in between, and you named a couple of them. Largely, consumer businesses, by definition, are fairly cash flow positive. Having said that, I think it's very early days in my personal view, to look at private equity investments in such assets, simply because the process itself, the IBC process, is still very nascent. The process needs to see some successes in other businesses before it actually becomes open for third-party capital. Right now, most of, and especially growth capital, bulk of private equity in India is growth capital. In my view, the process needs to be a little bit more streamlined. There needs to be clarity on timelines. There needs to be clarity on processes. There needs to be a clarity on, the level of haircuts. One of the big questions that one of the bankers came and told me is that, listen, he's part of the NCLT process and he's the IBC process. And the fundamental risk that they're foreseeing is that, listen, if I sign on a haircut today, what's to stop somebody questioning me 5 years out? Right now, it's all kosher, it's all transparent, but, nobody wants to get involved in a mess 5 years out. So I think it's early days yet. I think we'd see in the first wave, we'll potentially see some of the distressed hedge funds come and play in the space. And my view is private equity would be at least 4 to 5 years out.
So if not the NCLT process, and I agree with you, I think it's very unlikely that folk around this table in this room are going to go out unless you're a special situations fund and have a different DNA. But there are distressed portfolios. You don't score a 10 on 10 on your portfolio. And as there are many funds out here. I would probably think 2 out of 10 of your portfolio companies are really stars. 6 on 10 sort of middling. 2 are probably even distressed. So there are funds with large portfolios of investments with probably middling to lower performing assets. Is that an opportunity? Is that what you were referring to, Sandeep? Or is that a source for Sahil? Do you look at such assets from other portfolios which you think you could drive a bargain and yet have the confidence of turning it around?
Sure. So, I echo what Sandeep had said earlier, right? Which is, most of these consumer assets are not fundamentally distressed. They may not have done well, but because consumer as a sector does throw off cash, especially when businesses are mature, they are more hairy businesses. So they're either undermanaged, they don't have a lot of things going right for it. And so we go in and with a clear mandate of how can we fundamentally fix a lot of the issues and create value. Take, for example, one of the businesses which we invested in a couple of years back, Crompton Consumer. Right? It was a business which was owned by the Avantha Group. They were leveraging the cash flows from that business to really grow other parts of the Avantha empire. And so the mandate when we look at these type of hairy businesses which have gone sideways for a while is can we go in and how can we go in and turn it around? And the pillars are, generally quite similar across those businesses. The first pillar is really bringing in a strong management team. And the management team is not a CEO, but going into C-1, C-2 type of levels and really recruiting 10, 20, 30 people into an organization as and when required. Then strengthening the board around it, because the governance framework that allows you to drive meaningful value creation is quite substantial. The value that strong executives who have done this in the past can bring to a business from a board standpoint is always underrated. And we've really seen the value of that across all the portfolio companies where we are managing to kind of move a business from a certain trajectory into a better trajectory. And then we go in using those 2 key pillars to then see what more can we do to transform the business. Can we work on procurement to fundamentally improve the cost structure of the business and move it to the left of the cost curve? Can we work on supply chain and S&OP processes to improve the OTIF rates in businesses so that we don't have consumers walking into a channel and not being able to get the product? How can we make advertising more effective? to fundamentally increase top of mind, aided, or spont recall? Where can we help in fundamentally driving M&A in a business, either through just acquiring businesses or through licensing, to fundamentally change the performance of the business? So, all of that requires a lot of hands-on involvement, which may not necessarily be a distressed business, but fundamentally a very hairy business which you need to transform. And that's a common theme that we use across all our investments, because we like to buy businesses that are undermanaged, like to buy businesses which have struggled, but which still have a good, strong foundation, a good, strong core, which we can go in and then transform through all the toolkits that we have, having done this in other businesses.
I would add that the other kind of business that is now coming about are businesses that are at the end of a life cycle of a earlier fund. So there are a lot of funds that started in 2006, 2007, and the businesses are doing fine, but the fund is at the end of their life cycle. And so they're not even hairy. They're just going along their path. They just need more time, and they'll come at a massive discount to whatever the perceived value of that business is, only because the fund, the underlying money needs to create liquidity. Yeah. And that's something new in India, because we're so new, the industry is so new. So all these things are kind of coming out, and you can see a lot of these secondary portfolios that are taking large chunks of someone else's portfolio, specifically because the portfolio needs, the fund needs the money, not because of anything wrong with the company. Those are great opportunities.
Absolutely. But why isn't that much? I don't see enough entrance in that market. And I think, of course, we see funds coming in from Hong Kong and China who've used to seeing the deal flow in, end of life cycle fund portfolio companies. Why is that not an opportunity for some of the more mature funds, or even folk like yourself, Sid, in terms of picking that up?
So I'll tell you the problem that we face. We're not qualified enough yet to be able to value the businesses at that stage. And I think that it's tricky. You have to know what you're good at and what you're not in it. And so the structure, and I think part of it is just learning. So we did a secondary transaction. We bought out Kleiner Perkins' portfolio in India, and we raised money for that. And we raised external capital to be able to do that. And I remember we walked into our first meeting thinking, are they going to give that portfolio, what multiple will they give that portfolio? Literally, that was our thinking. That was 5 years ago. And they wanted to know what discount they're going to get. We didn't even know that they would ask for a discount. That's the level of, now we've smartened up since then. Let's not get carried away. But I'm trying to make a larger point. I think that we personally, and I think a lot of people in our community, as much as I might understand the business, I might be able to value a business that's 10 years old versus my ability to know what kind of value I can get out of a business that's only a year old or 2 years old. It's a very different game. And so to get that game, I think, unlike maybe where Sandeep might be.
Sandeep, some insights before we close?
No, when I use the word stress or distress, it's not the NCLT type thing, which seems to be a new flavor, and is relating more to where the banks are involved. There's been tremendous opportunity for us going back 15 years, not just in consumer. Our early deals were in the tech services space, which again, counterintuitively, was cash flow businesses, right? But we took control of SIFI in 2002. We took control of IntelliGroup in 2004, Visualsoft in 2005, something like that. And these were all stressed companies that worked out pretty well for us. And again, a lot of it is just going in and applying management 101. It's not rocket science. Companies that, were mismanaged for a variety of reasons. We've seen those again in some of the consumer assets that we've acquired in the last 5 years or so. And in fact, as I alluded to earlier, we've had far better outcomes in the turning around of these stress situations than these so-called all singing, all dancing stories that have generally been a little more disappointing.
All right, on that note, thank you. I think we're pretty much on dot. I'm assuming no questions, but if there are any, happy to take. If someone's changed their mind. But otherwise, thank you for being a great audience. And thank you, everybody.